Thanks for joining us today on The Close. I'm Morella Fernandez. Markets close in 30 minutes. Let's get to the stories we're following out of the BNN Bloomberg newsroom. Profit fell in the latest quarter at BCE, but topped analyst estimates, supported by growth in revenue and stronger performance from its business and media divisions. Bell Media continues to benefit from digital streaming growth, including gains at Crave and sports streaming platforms. Bell also highlighted rapid expansion in AI-related business services. BNN Bloomberg is owned by Bell Media division of BCE. We'll find out more when we speak with BCE President and CEO Mirko Bibic tomorrow on the Open, 10 a.m. Eastern Time. Shares of Linamar trading higher. After the company reported profit in its most recent quarter, the topped estimates. Revenue also rose 16% to nearly $3 billion. Linamar says new American tariffs will have more impact on its industrial segment, but won't impact its overall business outlook. The federal government projected a nearly $67 billion deficit for 2025-26 in its latest economic update, almost $12 billion lower than a previous estimate. The update also outlines spending billions on training and raising Canada's standard of living. Still, there are some concerns that the deficit is being used to spend more. BNN Bloomberg's Amanda Lang spoke with the finance minister, and he says given the fog of uncertainty, the move is to help Canadians in a time of need.
The concern of people is affordability. I think we have demonstrated we are a good fiscal manager. We have restored fiscal discipline, but at the same time, you have to be where people are. I mean, if we were to go on the street, the concern of people is affordable homes, it's grocery, and it's gas. So we've used, we had $7 billion of additional revenues. We used about 2/3 of that to help people now. We struck the right balance between using some of these revenues to help people, but also to reduce the deficit.
Tune in to Taking Stock with Amanda Lang. That's tomorrow at 3 p.m. Eastern to see that full interview. Quick look at where we stand on the markets right now. The TSX down 137 points, or 0.4%, to 33,844. Having a look south of the border, the S&P 500 down almost 0.5%. The Dow Jones down 0.7%, or 334 points down. The Nasdaq down about 0.3%, 69-point drop on the day. While higher oil prices have weighed on stocks, earnings have been robust enough and will support equities, barring any prolonged energy shock. Let's go to our next guest on this, Pierre Ouimet, head investment strategist at UBS Canada. This is what you're thinking, whether or not there will be that longer-term effect from the oil prices. How long do you think they'd have to stay elevated to see a major impact on equities?
Well, good day, Morella. Nice seeing you. And I guess that's a big question, really. It looks like they're going to stay elevated at least until the summer. So the question is there going to be some kind of a peace deal between the U.S. and Iran? And looks like that seems to be falling apart today. So it's from one day to the next. It's it's up and down like a yo-yo. It's unbelievable. So I mean, the demands on both sides are. They're not necessarily realistic, but, it's hopefully we'll make our way towards some kind of an agreement at some point in time. But beyond the summer, I mean, if the Strait of Hormuz is still closed, it's going to spell trouble for the global economy. I mean, even now, with just a shortage, actually, we're going into the period now where that part of the conflict where the shortages of products are going to start having to have a real impact on the economy. So that's going to be critical. And, right now it's anyone's guess as to how this eventually is resolved. So it's it seems like the U.S. can't really back out of this because they would be really to have waged a war for not much in terms of actual concessions or wins, really. I mean, the regime is still in place, and Iran will continue to export oil, and unless they get some concessions on the nuclear side, but it's hard to see exactly in which direction we're headed right now.
Okay, You like commodities, including gold, but it hasn't proven to be the shelter from the storm, at least during this conflict. It's actually fallen through. Moving forward, you think it'll gain back strength if there's a resolution here?
You mean gold?
Gold.
Yeah, we're really surprised by the way gold has behaved. I mean, it's almost become a hedge fund favorite. It looks like there's more. Every time the price of oil is up, the price of gold goes down, and vice versa. I mean, it's unreal, really. It's no one really wants to get too close to the commodity as long as this volatility exists. So it's we still believe gold is a place to be longer term, and it has nothing to do with the war. I mean, the war just would amplify that. It most has to do with the risk premium, sovereign debt, the ongoing deficits in the U.S., and the capacity of the Treasury to be able to finance that debt over the longer term. I mean, there's going to come a day when there'll be no bid on the Treasuries. I mean, who's going to buy these Treasuries anyway? Right now, it was $11 trillion that they have to refinance this year, plus the deficit, which is another $2 trillion. That's about a third of the total debt outstanding right now. It's insane. Who's going to buy this? At some point, someone's going to say no. And, the term premium will just keep going up. So that's a big risk, really. And I think when you come to that point, well, that compromises the U.S. dollar. And obviously that means that the only safe haven left really is gold.
So, Pierre, I know you're bullish on the U.S. consumer for spending, but we heard from two big companies today, McDonald's being one, Whirlpool being the other, and they have fears about consumer confidence. McDonald's is saying the second quarter might look very different. Will you adjust your outlook if you begin to hear more of these concerns from some of the big American businesses?
Yeah, it's going to be kind of a work in process. But yeah, McDonald's caters to the low-end consumer, and Whirlpool is all tied into the housing. I mean, both of those are not the strong points of the U.S. economy. Actually, the only strong points of the U.S. economy right now are government spending, AI spending, which has been bumped up for this year and next year, which is absolutely extraordinary. And I guess the other part of it is the top 20% of income earners. So it's the K-shaped economy and depending on where you are and who you're selling to, the cyclical parts of the economy, like autos and housing, they're just not about to rebound. That's not going to happen. So it continues to be kind of a weird economy in the U.S., but it's not necessarily generating a lot of GDP growth, but it's enough to sustain the economy going forward. So
on that note, you're looking at diversification, which is always a good idea, but beyond sort of the big mega cap tech, where are you looking?
Well, look at our base case, for example, and we've kind of adjusted the probabilities on our three scenarios, and we've increased the risk on the worst case scenario. So, yeah, in terms of diversification, where are we looking? We're looking for, for example, Swiss equities. They'll look attractive, as well as the Swiss franc. I think you have to hedge to a certain extent, looking at commodity markets. That's not only oil and gold, but also base metals. I think you have to, real assets. We diversify into alternative assets as well. Now, that could be any form of alternative asset, really, from structured products all the way to asset-backed securities in general look attractive, but it has to be specific to certain niches in various markets as well. So you have to be selective there. But I think Canadian equities, as a rule, look pretty good. It's actually one of the markets where the earnings revision ratio is the highest. And that's a miracle of this. And I still don't have any answers to this. This is the whole miracle of what's happening right now is the strength in earnings. It's like it's quite. I mean, the U.S. economy is slowing, and the first quarter earnings were extremely robust. I mean, it looks like year over year we're looking at the mid 20% increase in earnings on a year-over-year basis, and the consensus for 2026 has actually been increased to plus 20% year over year. So it's where is all of that productivity and where is that leverage in earnings coming from? We'll just have to kind of see as we go here. Obviously, there's going to be a lot of cost saving. What's going to be the impact of that? We think the impact of AI won't be until 2027 in terms of its impact on employment. But over time, I think what's going to happen also is rates are going to come down. So you have to have some diversification into fixed income, but not go out too long either. I think the belly of the curve is the best place to be right now. So the 3 to 8, 9 year kind of period for fixed income. Yeah.
All right, Pierre, got to leave it there, sir. Appreciate your time. Thank you.
Absolutely. Thank you. Have a good day.
You too. When we come back, the CFO of Sun Life Financial joined us to break down their first quarter results. Back in a moment. Sun Life shares slipping today after the company missed expectations for assets under management. You can see shares down 4.76% right now. The firm's profit crept up slightly compared to last year on higher health insurance premiums. Let's bring in Tim Deacon. He's CFO of Sun Life Financial. Thanks for joining us today.
Afternoon, Morella. Pleasure to be here.
So underlying net income, let's start there, came in over $1 billion, but reported net income coming in at $465 million. Tell me about the gap.
Sure. Well, we're very pleased with the performance this quarter. It was a great start to the year. As you mentioned, underlying net income for us was $1.050 billion for the quarter, and EPS was up 4% year on year. And that was really on the back of very strong performance from our Asia business. That was up 17% year on year. Our Canadian business up 7%. Both of those businesses are ahead of the medium-term objectives, and strong continued momentum from our U.S. operations, which was up 6% year over year. On the reported net income, that was really impacted by two items in the quarter. First was the impact of the final purchase price for the private asset affiliates that we acquired during the quarter. So this is BGO, our real estate subsidiary, and Crescent Capital, our private credit arm, as well as a one-time charge for a settlement of a legal matter related to MetLife policies that we had acquired through historical acquisitions. These were policies sold in the 80s and 90s. And that brought resolution to that matter. So that's really accounting for the biggest part of the difference between our underlying and reported net income.
Okay, let's get to assets under management, which did come in short of the $1.61 trillion estimate that was out there. So what happened there?
Well, we had good momentum in our asset management businesses. Our assets for MFS, which is our publicly traded vehicles for mutual funds in particular, was up year on year. That had positive momentum. And as well in SLC management, which is our private asset business, it also had positive momentum at $3.9 billion of net inflows for the quarter. So we're actually up from where we were at the prior year, as well as from strong performance in both businesses.
Were there just larger redemptions from people that were unexpected?
Yeah, so on MFS, has been a trend for some time now in the active mutual fund business, particularly in the U.S. That part of the business has been in outflows. So outflows did creep up from the fourth quarter in MFS. They were over $16 billion in the quarter, and that was split for both retail as well as institutional investors. On the retail side, that really reflects investor preferences in the current environment. And on the institutional side, that was more a reflection of institutional clients rebalancing. Now, MFS has seen positive growth in a number of areas. First off, in fixed income, they're one of the top performers in fixed income, and that's had great momentum. They've also had great growth in their active ETF offering. They hit $900 million in sales in the quarter, and that's a record since they've launched their ETF series, as well as they've also had positive experience in the separately managed account. So there's a couple of features in there that are also helping to offset some of the retail mutual fund outflows in the U.S.
Okay, let's take a more regional look right now. Insurance sales are down in Canada year over year. What led to that?
There's some seasonality in that. Part of that was because we had large sales on the group benefits side in the prior year, and those tend to be episodic. They don't always come in every quarter, and they tend to be larger. So we just didn't have as much in the quarter. And on the individual insurance sales side, we had positive momentum, but we've been pivoting away from a participating par product. That's a product that's been very attractive in the industry. It's great for our policyholders. It's less friendly to shareholders because most of the profits are shared with the policyholder. So we've been actively pivoting to have a more balanced portfolio on the insurance side, and this is just reflecting some of that transition.
Sales?
We did see large growth, though, on the wealth side. wealth side, though, in Canada, and that's helping to offset some of the sales in the insurance side.
Asia, I know, is a growing market for you, exceeded $1 billion for the first time. Is there a specific country or series of countries in Asia that are giving you that boost?
Sure. We've been really pleased with the performance of our Asia business. As you said, $1 billion. That's the first time it's crossed that in a quarter. And that came from a couple of our regions. First off, in Hong Kong, which we've had phenomenal success. Sales there were up 75% year on year. And that was double-digit growth across all of our distribution channels. So the broker network, our agency force, as well as bancassurance. But we're also up 40% year on year in Indonesia and 56% in Malaysia. So that's showing that the power of our diversified business across Asia and the local markets across the ASEAN regions that are also performing quite well. So it was a nice mix and balance across Asia this quarter.
Tim, I know you're using AI to do more underwriting. I'm wondering how that is going, how much you're using it in underwriting, and where else you are using AI right now.
Yeah, we see tremendous opportunity and benefits from AI. The underwriting process is one area, also in our claims processing. And we've also had success in contact centers, making our help desks more efficient, as well as in our advisors. So helping our clients become more efficient when dealing with an advisor and helping summarize, taking call notes. On the services side, we see great opportunities for AI in our IT departments. So all of our developers, about 90% of them, in fact, are using AI to have better code and to have better solutions to be able to deliver to our clients. And so we're seeing that helping ultimately resonate in better client experience. It's helping on the growth of our business, and it's also helping us become more cost effective. So it's really exciting to see the opportunities, and I feel like as an industry, we're just getting started.
I was going to ask you, are there efficiency goals that you have for AI?
We really see AI as an opportunity to really help deliver on our medium-term financial objectives. So we've not put out an explicit target. We do see both revenue opportunities, so new markets and channels that we can grow in. I talked about some of the efficiency opportunities, but also opportunities to leverage the great data that we have. If you think about the over 80 million customers that we serve globally, the information that we have around healthcare benefits and outcomes and helping our clients achieve better outcomes. On the efficiency side, we have tons of opportunity where we can continue the digitization of our businesses, reduce the manual work, and ultimately that allows for more straight-through processing and better client experience.
Tim Deacon, I got to leave it there. I'm out of time with you, sir. Thanks for your time. Tim, CFO of Sun Life Financial. Canadian mining company Sherritt has halted its joint venture activities in Cuba. We'll tell you why when we come back. There is clear and public condemnation after revelations that one of the biggest tech companies in the world breached Canadian users' online privacy. CTV senior correspondent Judy Trin has that.
Watchdogs from the federal government, BC, Alberta, and Quebec found that OpenAI violated privacy laws across the country as it developed its ChatGPT technology.
Our joint investigation highlights the importance of prioritizing privacy in the development, deployment, and ongoing evolution of artificial intelligence.
The joint investigation began in 2023. It found that ChatGPT scraped information from across the internet on adults and children. Private information like health data was collected without consent. False details were found in searches, and users couldn't correct the info.
To initially train ChatGPT, OpenAI scraped vast amounts of personal information from publicly accessible websites. This was widespread and indiscriminate.
Concerns about the lack of safeguards followed the Tumbler Ridge tragedy. OpenAI failed to flag the shooter's troubling interactions to police. The company is facing several class action lawsuits in Canada and the U.S. Canada's privacy laws were developed more than 20 years ago. The commissioners want stronger regulations.
The kind of regulation would require companies like OpenAI to evaluate the risks of this technology and to mitigate those risks before launch.
The privacy watchdogs say OpenAI did fix some of the problems in later versions of ChatGPT. The federal government is in the process of drafting new AI legislation, but for now, it's relying on private companies to police themselves.
CTV's Judy Trin reporting. Shares of Sherritt International plunging today after the Canadian mining company announced it's suspending its operation in Cuba. Bloomberg's editor for America's Energy and Commodities, Doug Alexander, joins us on this now. Thanks for joining us. I know Sherritt's been operating there since the 90s. They've been there for decades. What exactly is Sherritt saying about its operation? Are they pulling people out?
Yeah, so I mean, Sherritt has been there for, since 1991. You're correct on that. What they've got there is basically a joint venture with a Cuban company that operates a nickel and cobalt mine in the eastern part of the island. They also have a 1/3 stake in another joint venture that provides energy, electricity, oil, and gas to the country as well. So they're in the process of actually exiting those joint ventures, which means they're no longer going to be in there.
Okay, give us the broader strokes of why they're doing that. The U.S. has been cracking down on Cuba and now essentially cracking down on foreign partners through the country.
Yeah, and that's true. I mean, this is, to be clear, a really big blow for Cuba. As we know, the Trump administration has been ratcheting up pressure and extending sanctions on the country. This is the latest move, obviously. What it's going to do is basically hit up areas that are really important to Cuba's economy. So, energy, the mining sector, and of course, all the employees that work for these joint ventures.
I know that Sherritt also provides energy for Cuba as well. Was that operational still, considering what's been going on with the cutoff of fuel?
Yeah, we've actually asked the company what's the impact on that 1/3 joint venture. We haven't heard back yet, so stay tuned on that.
What do you think this means for Sherritt moving forward?
Well, you got a couple issues here. Obviously, this is going to affect the bottom line. They do produce nickel and cobalt from this mine, and part of that operation is also refining it in Canada. Now, in terms of the broader impact for the metals market, it's not so much. The amount that they produce is about 38,200 metric tons. That's just a tiny sliver of the production of these metals in the world. So it's going to be a big impact for Sherritt, obviously losing that capacity. But in terms of the metals market, not so much of an impact.
Bloomberg's editor for America's Energy and Commodities, Doug Alexander, joining us with the latest there. Thanks for the update. Up next, the closing bells on Bay Street and Wall Street. Here are the closing bells for the end of the trading day. Women in PR North are ringing the bell today for the S&P, and at the Nasdaq, Jack Henry ringing the closing bell. You're watching the close on BNN Bloomberg. I'm Marella Fernandez. Here's how we ended the day on Bay Street and Wall Street. The TSX Composite down 125 points today, or 0.4%. The S&P also down by 28 points, about the same, 0.4% down. And the Nasdaq down a little on the day, 32 points down. The S&P and Nasdaq, of course, had high closes yesterday, record high closes, so retreating on the day today. Let's get to the movers in Toronto, starting with the TSX B2 Gold. It gained 11% or 67 cents today, up on earnings. Kinaxis is where we are going next. They moved up 9.5% or $13.29, also on an earnings report. Moving to Maple Leaf Foods, it is up on an earnings beat. They are up 10%. Poultry, they say, driving revenue higher for them. On the flip side, Celestica is down today 7%. And then Nutrien, fertilizer, which actually had good sales, but down 7.5% after an EPS miss. Aritzia is down 4% today, or $6.09, and they will report earnings shortly. So stay tuned for that. Let's go to Bloomberg's equities reporter, Stephanie Hughes, who joins us with movers as well. Stephanie, BCE, the parent company of this channel, did report earnings. What are the highlights?
Yeah, that's right, Morella. So the trading day for BCE was kind of interesting. The shares were playing a little red light, green light to start off the morning, but ended up ending the day into the green with its highest level since in about a month. So you won't see it on the top or worst performing leaderboards on the TSX, but I'm going to take this opportunity to get into the earnings that they reported this morning. So BCE did manage to come ahead of estimates with adjusted earnings hitting 63 Canadian cents per share. A lot of that beat was driven by its business markets division, growing by nearly 10% over the quarter, thanks to a triple-digit gain in its AI businesses, which included the large data center projects that it has going out west. So BCE's Mirko Bibic says he sees other telcos sort of pulling back on their capital spending, and that's essentially what BCE has been doing as well with its telecom business. But where they're really investing that capital is in that AI build-out, where that's where they see the bigger growth opportunities. They also reiterated that they expect the AI-related revenue to hit $2 billion by the end of 2027. Beyond AI, the streaming service Crave was also faring pretty well. The subscriber growth hit 25%. That made this quarter its most watched quarter for the second time in a row, and like other telcos, just given the environment of the space, BCE is also grappling with a slower wireless growth as the federal government's curbs on immigration targets left the population growth pretty stagnant. That meant they have fewer new customers to actually grow those pools, and that's also left the largest mobile providers to aggressively cut their own mobile pricing plans to attract new customers in this existing pool. So in that context, it was pretty interesting to see that BCE still managed to grow its post-paid subscriber count and posted a gain from a year ago and actually came ahead of analyst estimates there. So Bibic told me that this dynamic has largely weighed on revenue, but BCE is looking at other areas for growth, obviously, and that includes this AI build-out, Morella.
All right, let's get to Tourmaline Oil shares dropping today after their earnings report. What did they share?
Yeah, so those shares dropped by over 6% at their lowest point today. That was its worst trading day in a month. So that came as they reported a muted earnings result, and more than that, they had a dual analyst downgrade. So it was a mixed quarter for the energy producer with a beat on adjusted earnings, a miss on revenue, and the daily production volumes were relatively in line. But what really hit the stock was the two analyst downgrades from BMO Capital Markets and Canaccord Genuity, both taking their recommendation to a buy equivalent to a hold. BMO analyst Randy Allenberger said his team sees limited room for further upside as the share price already kind of reached their target level, and it's already trading at a premium compared to its peers. So they also added that Tourmaline's exposure to U.S. Pacific prices, which BMO expects will underperform just given the growing storage levels. They said that also kind of informed their downgrade there. So that's why you're seeing pressure on the stock today. The earnings weren't all that great. They were kind of beige at best, and then two analyst downgrades really hit the stock lower there, Morella.
All right, Bloomberg, Stephanie Hughes in Toronto with the latest there. Thanks for that.
Thank you.
Let's get to movers south of the border. Bloomberg's Avalon Purnell joins us now. Avalon, Datadog was one of the top performers for the S&P. What happened there?
It sure was. Datadog went up more than 31% into the close for its biggest one-day leap since 2019. That's after the software company offered a really great print, really great first quarter results, and also boosted its full year guidance. Part of that is based on AI. It's really helped to shake off a lot of concerns for software as a service. A lot of other companies have also been taking hits throughout the year, but Datadog has been able to kind of get out of that a tiny bit. KeyBank Capital Markets writing that it was Datadog's strongest revenue beat since the COVID era, and those results have lifted its peers like Cloudflare, HubSpot, and Snowflake higher into the close as well.
Okay, let's get to some of the consumer companies that have reported earnings. And there are concerns that they're raising about American consumers moving forward.
Absolutely. We had a ton of consumer companies that were reporting this past week, and there's definitely an interesting picture that they were painting about what the U.S. consumer is looking like. McDonald's saying that there's still a lot of pressures on their customers and that those higher gas prices are leading people to stay at home. The company behind IHOP, Dime Brand, said something very similar, that instead of eating out, a lot of people are choosing to stay home as well. And even Warby Parker mentioning that they're a little bit more cautious as younger shoppers are choosing to go elsewhere, as they're really starting to feel the pinch from higher student debt and also higher unemployment that's really hitting consumers from all different directions.
Whirlpool also reported, and they ended at its lowest levels in 2011. What happened?
Yes, Whirlpool dropped 12% into the close today. That's after the household appliance manufacturer slashed its revenue forecast for the full year in half. It said that the war in Iran resulted in recession-level industry decline in the U.S. as consumer confidence continues to collapse. It also decided to suspend its common dividend as it continues to prioritize debt paydown in this uncertain environment.
All right, Avalon, we will leave it there. Appreciate you joining us today. Bloomberg's Avalon Purnell. Up next, stocks retreated as oil prices turned higher. More on the markets and some investment ideas when we come back. Even as AI continues to lead stocks higher, any break in the wave of AI spending could create opportunities in many companies that use or support AI. Let's go to Chad Morganlander, Senior Portfolio Manager, Washington Crossing Advisors. Thanks for your time today.
Thanks for having me.
Do you anticipate a break in AI spending?
Well, it perhaps will continue to go for another 12 months, but eventually there will be a deceleration of that capital spending cycle. And the key word there is cycle. And there are a lot of companies that typically trade at 8 or 10 or 11 PE multiples that are trading in the 30, 40, or 50 range now, because there's an expectation of perpetuity rates and growth that will go on for many decades. And I don't believe that to be the case.
All right. So where are the investment opportunities you see tucked into that break?
Well, you can look no further as the software companies. Many of them have been beaten down tremendously, and the multiples there are quite attractive. That too, you could also look at consumer staple and consumer discretionary.
The U.S. and Iran say they are talking. It's up and down, every hour of the day. If oil prices fall far enough, if this conflict is deemed to be done, do you think it'll fall far enough to ease inflation concerns at the Fed?
I think the Federal Reserve is going to be on hold until the end of the year. The inflation numbers are stubbornly high. So there's going to be, I believe, a reduced probability of the Fed, lowering rates 1 or 2 times. At the beginning of the year, I think everyone was penciling that in, and that has now been taken off the table.
All right, let's talk about the state of the American consumer. We've had some of the front-facing consumer companies talk about concerns. McDonald's is one of them. They're saying that their second quarter results might be very different from their first quarter results, which were good. Whirlpool also talking about a slowdown. Are you concerned about the American consumer at this time? What do those sentiments mean to you?
Yeah, it's a tremendous concern. It seems as if that K-shaped economy, when it comes to consumption, is really, quite prevalent. The rate of oil prices going higher it seems to be sapping from consumption for the mid-tier consumer. You're seeing that within the earnings announcements that are being announced. Planet Fitness, which is today announced, really disappointing numbers, and of course that stock plunged. So there is a typical concern here. The economy is healthy when you look at it from a bigger perspective because of capital spending cycle, but it's not making its way down to the U.S. consumer.
So where or how are you positioning right now? What is your theory behind it?
Okay, so on our asset allocation strategies, which is global in focus, we're underweight U.S. equities. We are overweight international. In particular, we are overweight EM as well as developed. When it comes to our stock bond allocation, we are overweight U.S. But I will tell you, there is a tremendous seam of opportunity today in high quality, lower volatility companies. The PE multiples for those companies are quite attractive. They've compressed in a drastic manner, due in part because of this high volatility trade that we've seen over the last 24 months. And that's really where the seam of opportunity is.
Okay, so let's talk about one or two of those. Moody's is one that you like. Tell me about where Moody's is at and why you would pick it up.
Because there's a tremendous fear that artificial intelligence is going to replace certain business models. And the credit rating agencies, although they are quite expensive to use their services, these many companies are restricted from shying away from getting an S&P or a Moody's rating. This will make Moody's much more efficient, as well as they sell as a data vendor various high margin services that perhaps AI will not be able to replicate. So Moody's multiple has compressed. It's growing, it's profitable, has very little debt, and it's a rising dividend stock. So we would actually find that one to be quite attractive.
Let's get to ADP, which is a processing service. Tell me about why you would put money there.
Yeah, so the thematic for all these companies is going to be multiple compression because of fear of AI. ADP has come down about 25% year to date. There is very little evidence of a deceleration of their business trends. In fact, we believe that artificial intelligence, once it's starting to become implemented into their corporate business flow, that will improve operating margins drastically. It's a business model that is highly compliant, and there is very little, we believe, business risk when it comes to artificial intelligence. Growing, profitable, well-capitalized, another chestnut that we would put away for a couple of years.
Yeah, I think people are discounting, as you say, those companies using AI to make their business better. They're just thinking about those companies being taken over by AI. IBM is the third pick you have under the same banner.
Yes, this is another company that is not only able to provide actual solutions to corporations across the globe regarding artificial intelligence, but they're able to do it as a cheaper alternative. Not only that, but you have the bookend of quantum computing. This company's revenue growth has to grow around 5 or 6% to justify that valuation where it is today. The multiple's compressed. If they surprise as this surge of business spending continues and it grows at 7 or 8 or dare I say 9% organically, this company could be a handsome reward from a capital appreciation perspective.
Chad, I've got to leave it there. Chad Morganlander, Senior Portfolio Manager, Washington Crossing Advisors. Thanks for your time.
Thank you.
Up next, Knight Therapeutics shares up today. That company boosted their full year revenue forecast. We'll hear from the CEO when we come back. Knight Therapeutics, a Canadian specialty pharma company based in Montreal, reported record results in the first quarter. We got more from Samira Sakhia, President CEO, Knight Therapeutics.
Starting to show the classifications a bit differently is to really have our investors understand how we internally manage our business, which is what are we promoting? What are the drivers of growth? The drivers of growth is those strategic products. They've been around for a while, but still are close to achieving their peak sales or have achieved their peak sales. The really the pipeline, which is really the driver of the future, is what we are doing more of and spending a lot more time on. And if I look at that pipeline, we've provided guidance that we expect our pipeline products that are in early launch or to be launched will be achieving at least $200 million of revenue. And as we noted in our statements, 40 million on the products that we've achieved we've already achieved on a trailing 12 months basis, $40 million of top line from those launch pipeline products.
And what are some of the products? Let's talk a little bit about that to let people know more. What are some of the products and which are the ones that you have a lot of confidence in moving forward?
Perfect. That's a great question. So we have a whole bunch of products in LATAM. Minjuvi is one of the big ones that we launched it in 24 in Brazil. We've launched it in Mexico last year and in Argentina earlier this year. It was launched in one indication. This year, we're already launching it in a second indication that we got approval for. We look to launch that second indication, hopefully by early next year in a couple of other countries. And that's got a lot of growth coming towards it. We've got, in Canada, we are launching Jornay PM, which is a product for ADHD in children. We have a whole bunch of women's health products with Imvexxy and Bijuva, which are hormone replacement therapies. We have Myfembree, which is for endometriosis and uterine fibroids. We have a couple products in prostate cancer. So the list is ongoing, and this is really the raison d'être, the reason that we do what we do, which is to bring innovative products to our key markets that make a difference in the lives of patients. And we do this all the time. The exciting part is that we've been licensing these products over the last 5 years. We've gotten them approved, and now they're really hitting the ground. We're launching them. And as we're launching them, our shareholders can now see, our investors, that those brands are needed in our territories. They do have an impact, and they are growing because of that.
I was going to say, with women's medical products, I imagine there must be a huge opportunity there for you.
There is the way we look at each, whether it's a product or a product category, is really where is there a need, where is there a pipeline, and what can we bring to our territories, whether it's Canada, whether it's Latin America. Obviously, we're always looking to license products for all of our territories, but sometimes maybe the partner is here already for themselves, or the issues of pricing and reimbursement in Canada does not work. And so we may license for LATAM only, we may license for Canada only, but our objective is to continue to bring innovative therapies that benefit patients, physicians, the healthcare system, and that can drive long-term shareholder value.
And now you do face competition, generic competition. How are you handling that? What are your biggest challenges with it?
It depends on the product. It depends on the territory. We do have some older products in Canada that have been genericized. I mean, when I look at the Paladin acquisitions, a lot of those products that are mature already have generics. So they're really, that decline has happened, and so they've plateaued. If I look forward, there's a few products in our Latin American portfolio that are either going to face or are starting to face generic competition. The issue is that in Latin America, the way the market works is very different than here, and the genericization takes a lot longer. In Canada, you lose your market share within 12 months. In Latin America, that takes 3 to 5 years to kind of go to that 10 to 20% market share, which allows us to kind of continue to work with that product, benefit from the cash flow while we're launching and investing in new products that hopefully go beyond that decline.
Okay, one last question. With guidance for the rest of the year, where is that? And what are some of the concerns you have for managing development risk or any potential development risks?
Sure. So we did increase guidance to 510 to 525 million. Some of that's coming from currency, a tiny bit of that. The rest of it is coming from the growth or the forecast that we're having for some of our products in Canada, in Colombia, in Mexico, where the teams are executing really well. The risks that I see is we're a licensing organization. We don't do a lot of development. The issue is, how quickly can we bring in more? How do we take what we have, get it submitted, get it approved, get the right pricing and reimbursement for it to be impactful and successful? And that's something that we're doing all the time, but it is now accelerating, and we need to keep that momentum.
Samira Sakia is President and CEO, Knight Therapeutics. Up next, what a key Quebec voice says Ottawa needs to do to reset trade talks with the U.S. Back in a moment. Here are the stories making headlines today. Shares of MDA Space closed higher today, up 6%, after profit in its first quarter topped estimates. Revenue also surged 32% from the year before, surpassing expectations. MDA's backlog also increased, driven by demand in its satellite and space infrastructure unit. The CEO, Mike Greenley, says the company still has a $40 billion pipeline of potential business to tap into. Canadian Natural Resources missed expectations for average production in its latest quarter, and reported output for crude oil and natural gas liquids fell short of estimates. The gas producer's bitumen production also fell 3.5%, missing consensus. One bright spot was revenue and profit beat expectations. Shares of Sherritt International taking a hit today. The Canadian company, which is a mining company, suspended participation in its joint venture in Cuba. The move follows expanded U.S. sanctions. And though the company has not been formally designated under the U.S. executive order, it notes a designation could occur at any time. Sherritt's bringing employees back from the island, says there's no immediate impact on its Canadian operation. CUSMA, of course, up for a review this summer. At a conference in Toronto today, Quebec's trade envoy said there is a growing belief in Washington Canada's dragging its feet on trade talks. Bloomberg's executive editor for Canada, Derek DeClue, joins us now to talk some more about that. Derek, did she share more details about this?
Yeah, so this is Louise Blais, and she's just been named as the Quebec government's representative to the to the trade talks, to the CUSMA talks, or as the Americans call them, the USMCA talk. She spoke at the Public Policy Forum conference this morning and said she's got this sort of feeling from her talks in Washington that this is a perception that's held sort of by both sides of the aisle. Obviously, Republicans being in power, being the president's party, they know that they kind of started this trade war. But even Democrats, she said, are expressing the view that Canada's drifting away a little bit, that it's not the ally that it once was to the U.S. And viewers can make up their own minds on why that is and and what happened there. But she did kind of raise the alarm, saying like we do have to make sure that we change this perception and that the talks do move forward. And so that was kind of one of her messages today to a large audience of business people.
What was her take on how Ottawa should deal with this?
Yeah, I mean, well, one thing she said we should not do, what the government should not do, is make unilateral concessions towards the U.S. to give something without getting something back. That has been tried before. Last summer, the Carney government gave up on the digital services tax because the U.S. was upset about it. And then a few weeks later, Trump just said, well, I'm going to raise the tariffs on you anyway. The Carney government, they got rid of the retaliatory tariffs. That was announced in August, and lo and behold, by October, the talks about reducing metals tariffs were off. So she said, we shouldn't just give something away, but we do have to do have to talk to the U.S. and we do have to make a strong effort to try to change the perception and make it clear that we do want a deal, and they are our number one customer and they are a valued ally. So a lot of it is kind of about I think the headlines and the press releases more than the substance of the talks. But there's clearly in the business community as well, I think, a little bit of concern about the lack of pace, or the lack of apparent pace, the lack of visible pace in the discussions between Canada and the U.S. To resolve some of these longstanding trade issues.
You also spoke to the man who was the chief trade negotiator in the last round of negotiations with the U.S. What was his insight?
Yeah, Steve Verhoeven, he's an interesting guy. Obviously, he was right on the inside when Canada and Mexico went round and round in the first Trump term. I asked him about, is there some sort of concession that needs to be made by Canada to sort of restart the talks? And he said, Canada should absolutely not consider giving something up without getting something back. You have to. It's a bit of a game of poker. He didn't use that analogy, but you need to hold your cards, and there's a big negotiation ahead. He's also of the view that right now the U.S. and Canada are far apart, and there's not necessarily a deal to be done, but that over time there will be pressures in the U.S. On the administration, in some cases economic pressures that will move them a bit closer, and that ultimately something can be done. And some of these irritants, like Canada's dairy policy, supply management, the lack of U.S. alcohol on store shelves of LCBO and other provincial liquor stores, that these things can get solved. But it's just, it's going to take time, and it's going to take the two countries' positions sort of drifting towards each other.
Bloomberg's Eric McLeod, thanks for the update. Appreciate that. Kinaxis closed up today after it reported a beat in revenue for its first quarter and demand for its Maestro agents. To discuss the latest report and more, we sat down with Razat Gaurav, CEO of Kinaxis.
We've been in the supply chain planning and orchestration space for some time, and we just built an amazing platform. And I think the big growth drivers really come down to three things. One, just the overarching increase in supply and demand volatility, given all the macroeconomic issues, the geopolitical issues, the tariffs. That creates a bigger need for our platform, for our customers. Second, I think, there's a lot of shifts happening on the technology side for our customers, and they're really looking to deploy modern solutions that can take them into the agentic age. And we at Kinaxis, we've been investing in our platform, and we've got the world's best supply chain planning and orchestration platform that has a ton of AI capabilities and agentic capabilities, and that's making us win more business. And the third reason is I think just our team is executing a lot better, right? Executing both from a go-to-market perspective as well as ensuring that we can deliver, value to our customers as well.
Now, you mentioned about shifts for customers. What are some of the shifts, and how are you keeping up with it?
Yeah, look, the shifts are very specific to different industries. We play in 7 verticals, but I'll give you some examples, right? So, in the whole high-tech value chain, for example, there's a big surge in the buildup of data centers, given the AI economy that's emerging. And that's impacting, a lot of companies that are not just the hyperscalers that operate these data centers, but also all the suppliers in that value chain. So the storage and device providers, the semiconductor chip companies, the energy utility companies, the cooling unit providers, right? And so it's creating a massive surge in demand while they're stuck with, fairly constrained supply. In other industries like aerospace and defense, again, we're seeing a surge in demand given what's happening in the world, but they are, constrained with supply and with very complicated bill of materials, and they need capabilities that really help them optimize to service that increase in demand. In other industries, like in CPG, for example, there's inflationary cost pressure happening with the surge in the fuel prices. Obviously, many companies got impacted with the conflict in the Middle East and with the blockades with the Strait of Hormuz. So they had to look for really rethinking and reimagining their product flows. So there's just a lot of disruptions that are happening in the supply chain world, and all of that creates the need for an agile solution that allows them to balance demand with supply, quickly run scenarios, do replanning capabilities in a smart, intelligent way, leveraging data and algorithms, and that's what we do at Kinaxis.
And is this where the Maestro agent is coming in, and the new tailored agent composability? Can you explain a little bit what that is?
Yeah, so what we've been working on, and we announced this last quarter, we've been getting great early adoption with our agentic infrastructure as well, where we've ingested within Maestro, our core Maestro platform, an agent studio, and we've also released several packaged agents. And these agents are really designed to drive productivity improvements, to really drive, automation in the workflows for our customers in their end-to-end supply chain planning and decision-making processes. We've also attached to Maestro now an agent studio that allows the composability. So now you don't have to just be constrained by what you get out of the box from us. You as a customer or our partner ecosystem can also compose agents based on different use cases, and they have access to all the data and resources from across all of Maestro to be able to compose those agents for driving automations, driving intelligence, driving predictions, and also driving all kinds of productivity improvements.
Okay, I want to jump in about SaaS was up, revenue was up 21%. Do you see that as sustainable with everything that's kind of unfolded with SaaS lately?
Well, we've given our guidance and we've been very comfortable with our guidance. We gave a guidance of 17 to 19%, and we reinforced that guidance on our earnings call this morning. We're very confident that we'll either meet or beat that guidance. But look, I think we have a lot of good momentum. Q1 was a great start to the year. We're seeing a lot of pipeline and a lot of activity in our customer base. So my goal clearly is to continue accelerating the top line growth while maintaining a very responsible and a profitable business model.
But any concerns about SaaS with what's unfolded over the last little while?
Not really. There's a clear dissonance between what we hear in the media and in the financial markets versus what we are seeing with our customers. Our customers, in fact, are doubling down with us. We're a SaaS company, but not every SaaS company is the same. We solve very complex problems that are rooted in deeply advanced mathematical models, leveraging machine learning, leveraging optimization capabilities. And we are leaning in and leveraging both generative and agentic AI in our core platform. So our customers are looking to do more with us. They're not looking to do less with us. And, with the line of sight we have, we see us continue to grow and thrive and create more value for our customers using all the latest and the state of the art in terms of technologies.
So this was your first quarter, right? I believe, as the CEO. Right. What do you do? Right. What do you do for an encore?
What do I do for an onboard?
What do you do for an encore? I mean, this is your first quarter. It's a good first quarter.
Well, I have every intention to continuing delivering every quarter. I mean, this is a long-term journey, as you know, and it's all about long-term growth as we realize our vision for becoming the supply chain decisioning and orchestration platform. But of course, we're going to keep delivering one quarter at a time, and that's my goal here.
Razat Gaurav, CEO of Kinaxis. Coming out, hot picks coming up. We'll zero in on 3 plays in the retail sector when we come back. Canadian clothing retailer Aritzia just reported earnings. Here are the numbers that have come into the newsroom for their fourth quarter. Adjusted earnings per share beat estimates. Adjusted earnings per share coming in at $1.15 versus 83 cents year over year. The estimate had been $1.03, so a beat for Aritzia on earnings per share. Net revenue coming in at $1.19 billion. That is a 33% increase year over year, and the estimate had been at $1.14 billion. Retail revenue, $698.2 million. That's a 35% increase year over year. The estimate had been well under $636.7 million. E-commerce, always key, revenue coming in at $488.3 million. Again, that's another 29% increase year over year, where the estimate had been $496 million. So they did not hit the estimate on that, but still had a 29% increase year over year. Here's a forecast for 2027. The company sees net revenue coming in at $4.4 billion to $4.6 billion, and the estimate had been $4.26 billion. So they're well above that with their estimate for their look ahead to 2027. And again, that was a Bloomberg consensus. It's time now for Hot Picks, and we looked at 3 retail picks. We were joined today by Arun Sundaram, Senior Vice President, CFRA Research, to discuss the picks, and we kick things off with why he likes that space in general.
I cover retailers throughout consumer staples as well as consumer discretionary names. And we're just coming off of Q1 earnings season right now as well, and a lot of them have a lot of positive commentary to say, despite the war in the Middle East and higher gas and oil prices, consumer spending has been resilient. We've seen that through not just for staple categories, but even some discretionary categories are performing well. I think in the U.S., a lot of that has to do with the fact that tax refunds were about 11% higher this year versus last year. So I think that's helped soften the blow from higher gas prices. But yeah, generally we're seeing resilient consumer spending. That's translating into strong growth for many of these retailers.
Okay, so let's get into it then. Walmart is your first hot pick for today. Tell us why you like Walmart.
Yeah, I mean, there's a lot to like for Walmart. It's been a top pick for a few years now. In the United States, it's growing their comp sales by in that 4 to 5% range. That's quite strong compared to peers. And importantly, it's not just groceries that's selling well at Walmart. Even their general merchandise categories, these discretionary categories, are doing well at Walmart. And part of that is due to the fact that Walmart is bringing in more higher income consumers in its platform. And a lot of them are also signing up for Walmart Plus, which is a subscription program as well. And then on top of that, their e-commerce business is just booming. It's actually growth in the e-commerce business is accelerated in the past few quarters. It's almost growing at a 30% clip right now. And even more importantly is that e-commerce business just became profitable last year. That e-commerce used to be a loss-making business for Walmart, but now that's profitable. It's growing at a 30% range. And the number one reason actually we like the stock is because the Walmart's business model is changing. They don't just sell goods inside their store anymore. They're actually selling advertising. They're doing fulfillment services. They have subscription-based revenue. These are high margin revenue streams for Walmart. And in fact, right now, about a third of Walmart's operating income growth is coming from these higher margin revenue streams. And that's good for overall margins as well. So I think over the next few years, you can expect to see some sizable margin expansion at Walmart.
It's so interesting. They're also targeting those kind of high income shoppers as well. So really interesting stuff. Okay, your next pick is Costco. Tell us why you like Costco.
Yeah. Costco is another one of our top picks. We've actually become increasingly bullish on Costco, I would say, in the last 3 to 4 months. And I say that because its valuation gap to Walmart is actually is closing. Costco used to trade at a pretty sizable premium relative to Walmart, but now in terms of their valuation, it's almost par. So we're liking Costco a bit more these days. Its comparable sales is even outpacing Walmart. It's one of the leaders in retail. Costco also has a strong runway for club expansion. They're growing their clubs about 25, 30 new clubs per year, half of it in the US, half of it internationally. It's also getting into these higher margin revenue streams like Walmart, and that's good for overall margins as well. And then last but not least, Costco typically they tend to pay a special cash dividend to their shareholders every few years once their cash balances kind of inflate. And if you look at their cash balances right now, it's back to the same level as it was a few years ago when it last paid a special cash dividend of $15 a share. So our expectation is we'll see another special cash dividend at Costco within the next year or so. And I think that's why you want to be invested in this stock as well.
Interesting. Okay, and last up, Chewy Incorporated. Tell us a little bit more about Chewy. It deals with like pet food, other pet-related products. Tell us why you like this one.
Yeah, so this is obviously a maybe more underappreciated play. People may not be as familiar with Chewy as they are with Costco and Walmart, but they are the leader in pet e-commerce. But more importantly, Chewy is not just selling pet supplies and goods anymore. They're also getting into these higher margin revenue streams as well. It's doing more healthcare services. In fact, Chewy recently, over the last year or so, they're actually opening physical brick and mortar vet clinics in the United States. And again, these are high margin business streams as well. And if you look at Chewy's fundamentals, it's pretty solid. They're growing their active customer base in the low single digits. Right now, they're also expanding their margins as well. They're introducing a lot more like automation into their fulfillment centers. That's good for their overall margins as well. And then last but not least, Chewy's they're free cash flow positive. They have no long-term debt, and they continue to buy back shares. The stock hasn't performed all that well over the last few years, but we think that's set to change. And so we have a strong buy rating on Chewy shares.
It's so interesting, too, because obviously, like as we talked about at the top, retail stocks are facing a complex environment this year. All three of your picks are looking at like higher margin revenue streams. Is that kind of what separates, the retail stocks and companies that are going to make it through versus some of the ones that might struggle throughout the year?
Yeah, no, you hit it on the head right there. That's in our coverage universe, retail is where we really like the play here. It's because of these higher margin revenue streams, and like I said, for many of these retailers, their overall margins they're growing because of these newer revenue streams, especially advertising. If you think about it, like advertising, the margins on advertising, the EBITDA margins on advertising is north of 50%. Whereas selling like groceries inside your store, you're making like 2%, 3%, 4% margins on that. So clearly, like these higher margin revenue streams are good for the overall business. And as these companies like Walmart and Costco continue to grow out their e-commerce business, they'll grow more. In conjunction, they'll grow their advertising business as well. And that's obviously, like I said, good for overall margins. And that's why we're bullish on these stocks for not just the next year, but probably for the next 3 to 5 years.
Arun Sundaram is Senior Vice President, CFRA Research. Up next, a closer look at McDonald's first quarter earnings. Back in a moment. We heard from McDonald's today as a fast food company reported earnings, and it warned that its next quarter may not be as strong, with concerns about the squeeze of consumers. Let's go to Bloomberg Intelligence Senior Analyst for Restaurants, Michael Halen. Michael, thanks for joining us today.
Sure thing.
Can you share what more they had to say?
Yeah, so, management is going to be lapping tougher comparisons. So, we were expecting a sequential slowdown. Management did say that the low-income consumers are, dropping off, right? Traffic is falling still from the low-income consumers, not as much as last year. Right. But, I would look at more what they're doing versus what they're saying to get a key read on what they think. And what they're doing is the most aggressive discounting I've seen since started covering this company over a decade ago. I mean, $1.50 sausage McMuffins, $2.50 McDoubles. They got $3 breakfast meals, $4 lunch and dinner meals. That's as aggressive as it gets.
Okay, I remember, I think it was last year, they offered $5 value meals and brought those back because consumers were already hurting. And I think those did really well for them. So this is along the same vein. They're just expanding it to breakfast and lunch, for example.
Yeah, but even deeper discounting. So I think it has two main reasons. Number one, I think they smell blood in the water. Jack in the Box and Wendy's, their two big competitors in the U.S. are struggling mightily. They had, mid-single digit declines in same-store sales last year. And I think McDonald's sees an opportunity to take market share from them. But it's also, they're seeing inflation spark again. And inflation move higher again. And that's bad news for their low-income consumers, right? And if they want to, try to keep those customers as best they can and keep the middle-income consumers as best they can, they think value is the best strategy moving forward. I mean, they're going to have some other things. They're expanding the beverage lineup this year, which may help. But that's a move that a lot of other quick service chains are making at the same time. So, yeah, it remains to be seen. So more of the same, but definitely more aggressive.
Let me ask you about whether they indicated that this had to do with the price of energy or fuel going up. And is that the reason they're worried about the consumer squeeze, or is it a much bigger picture?
Oh, yeah, 100%. I mean, the consumers have been struggling because of all the inflation that over the last 5 years or so. And, we were, before the war started, we were looking at, inflation, kind of creeping back down to 2%. And now it's well over 3 and moving higher to 4, right? And so that is going to be a significant headwind for restaurants. I mean, because people see the higher prices for gas and they pull back on their spending. And then on the other side, margins get squeezed because restaurants really can't pass along price increases right now, but food costs are going higher.
All right. I do have to leave it there, Michael Halen. Thanks for the insight. Appreciate you talking to us today.
Sure thing.
All right, that ends the day. Thanks for joining us today here on The Close. We'll see you back here again tomorrow.